Perfect. Perfect. Let me see what I have showing here. Okay. Um, all right, everybody. Glad that you are tuning in on today's June 18th, 2024. We're going to talk about some of the markets that are going on, right? So Bitcoin, Ethereum. There's been a lot of activity over the last week in particular, right, with some economic events. And then talk a little bit about some decision matrix, right? So talk about fact-based trading, and then we'll go into a little bit of an outlook, and then the application process of that, utilizing um, both futures markets and then options markets, right? So a focus today on the options side of things, because I am here talking about marketing, and that's my bread and butter. That's what I like to do. So before we dive into it, let's go through a disclosure here. General disclosure: all information and presentation are for educational purposes only and should not be considered specific investment advice nor recommendations. Cryptocurrencies, futures, options, forex, stock trading, all trading in general should not be used, and there's significant risk within doing this, right? So risk capital is the money that can be lost within jeopardizing one's financial security or lifestyle. Only use risk capital if you're in the game of investments and within trading. So within the futures market, options, derivatives markets, significant losses can occur, sometimes larger than initial capital deposits, right? So a brief introduction to myself real quick is my name is Spencer Regal. I am the chief options strategist here at Dharma Capital Trading, and our mission is to positively help traders achieve their full potential. We empower traders with fact-based solutions that enhance self-awareness and decision-making. Our approach enables traders to execute trades confidently and effectively by facilitating a state of flow. So one thing that we all talk about as traders is the flow state, right? That means that you're operating in the here and now. You hear that even in professional sports, any high performing um, uh, professions, basically, right? And so what that means is you're just acting. You know, what are the facts, and everything is relatively seamless, right? And so that's what we're looking to do here. So here, what we're going to talk about today, and we'll go through a quick slide deck, and then we'll get into the meat of it and talk about some markets, some forecasts, those kind of things. But as true to our form, what we're focused on here is fact-based trading, and that's going to be defined as involves making decisions based on objective data analysis, reducing speculation and subjective biases, right? So what's happening now? How does that impact me? How does that impact future? And then how does that impact current position and then future position as well, right? So all different time durations, all these kind of things, right? So as we talk about decision matrix, right, there's a lot of different things that we need to talk about, right? And so there's going to be 3 steps. So a couple things are, it's within identifying the context, and that can be done through the playbook, right? And playbook is something that we've spent tons of time on developing. It's all within qualitative analysis across asset classes, right? So that's know the state and its characteristics, know the structure and its bias, know the optimal and hedge strategy themes, right? So it's one thing to know what's going on in the market. It's another thing to know what to do when you know what's going on, right? Next piece here is identify the real-time facts using price map, right? So we'll go over that analysis today, and that's going to be our proprietary data as well. So identify if price action is performing to characteristics of the state, observe price action within the price map framework. Is it holding structure? And then identify the strategy theme that's best used to leverage that information, right? Excuse me. Last piece here is integrating Bookmap, right? And so if the market's performing to expectation, the state, and is holding structure, then look into the microstructure of the market, right? So where are those liquidity levels, where are those buyers and sellers in the market? And so that can be used and seen through Bookmap, right? And that can be used then to create the optimal strategy theme, right? So yeah, I think that's going to be pretty much it. For this part, we can run through the last couple of slides here, and then we'll hop over to the market and what's going on today. So, part of defining the opportunity of Bookmap is, did I go through this one? Yeah. So if the market's not performing to expectation as well, we can define that in Bookmap. And Bookmap really just helps with the execution, right? So um, on a very, very minute scale, right? What's happening here now within the order book, where are the buyers and the sellers? And so if you got a buyer at 70,000 Bitcoin, right, and that goes against some of the data and analytics, you know that you're at risk, right? And so that's something to take into account. And how are you going to hedge that, right? So let's kind of hop over here. Last pieces here are then going to be executing your tactics. So Bookmap also helps with this within standardizing that process. So it starts from the top down, right? Being playbook, heading over to price map, right? And then execution, which is going to be in Bookmap, right? And so that all of that can be done in an optimized, and that's the goal, right? Standardize and optimize the whole process, right? So let's bring over what we're all here to talk about. Let me bring that up. Let me also bring this over. I'll kind of downscale this a bit, drag it back a little bit. So this, we'll go through this is going to be your monthly Ethereum chart, right? And so there's a lot of things that we're looking at here, right? And so as we were talking about in kind of the slide decks, right, we're starting out with the top down, right? So currently, what's the playbook telling us? That's going to be over on our daily structure, right? And so our daily structure here is over here. And let me zoom this out so it's a little bit legible for all of us. Scroll out here, right? And we have Bitcoin up on Bookmap, so let's drag over Bitcoin here as well. Perfect. Okay. So this is going to be our Bitcoin daily structure, right? And so coming in off the day, we have what's considered to be our R level above the market. That means we have a negative sentiment bias on the market, right? The expectation is if the market's going to move higher, it's going to target this area, and the expectation it will fail, and then where will it fail, right? It'll trade back down to the directional. If it fails at the directional, then it'll trade down and lower, right? And that's exactly what happened over the overnight session, and where we got some of that downside pressure last night in Asia hours, right? I'm in Chicago, so that was happening around, what was that, 9 p.m., 10 p.m. my time. And then the next piece is, okay, after some of that selling, we're coming over here to Bookmap and looking at some of the minute details, right? So as we look at an analysis, let's go over some of the weekly structure for both Bitcoin, Ethereum. There's been some interesting orders that actually have hit the options market, and then some large macro events that kind of happened last week, and then there's some broader correlations that we're seeing both in cryptocurrencies, but also risk on assets broadly, right? So if we were to pull up, let's kind of downscale this. The great part about price map is it's on time frames, right? And so here you're looking at daily, weekly, monthly. Let me pull this up and make sure this is up as well. So here, let's pull up the monthly. Let's see what we're looking at. We're coming into the end of Q2, right? It's a pretty big week that we're looking at. Starting next week, there's some wide speculation that there's going to be positive ETF news. So some of that was being rumored on Twitter last week, right? July 2nd. Some people on Twitter were talking about as potentially being the new launch of the ETFs. We're looking at a US holiday, July 5th, right? So that shortens up the week. And then we're also looking at the end of Q2, right? So not much going on, right? And so, but at the end of the day, we're also in summer trading. And so what does that mean? So as we take a look, right, what is this map telling us, right? Currently, this DIR is going to be considered your monthly directional, right? It's easy to think that underneath that, the trade is in a corrective theme, right? So looking at 36.15, if we're trading under that, where are we going to trade to? We're going to trade to this CR minus here, which is your 34.6580, right? Which we held for a day. If we trade underneath that, where's the expectation where we go, right? Well, the expectation is we really start to probe lower. We have the our level here down near the previous month's low, that if we are to trade lower here, that's the expectation, right? So a larger move lower. As we hold this CR minus, right? Today we're under it. If we were to trade back over it, the expectation is that we could make a play here for our previous month's close, which is that PMC that you're seeing. And largely, what I'm saying here is there's a large digestive trade going on, right? So let's put that's the expectation based on the monthly analysis. Let's also put some knowledge that we know going on in the broader market. And come up with a thesis, right? And so we'll go basically start to finish on how we'd come up with a thesis, how we'd come up with a trade idea, and then we'll put some of that up on the charts too, and see how we could go about executing some of those things, right? So we have our price map, right? And that's our thesis here is because we're trading under both the directional and the monthly CR minus, the expectation is ETH is in a corrective state. And if that's the case, where could it go? Well, it could absolutely test this lower metric boundary down here of 2775. And that's the expectation of your monthly R level. Or we could come in and we could test some of these other levels here. The 3315, which is your monthly DP, aligns with some larger structure in terms of the quarterly. And so if we were to base there, that's also a good level to look at, right? And so, okay, let's come up with a thesis, right? So what do we know that's going on in the broader market? Well, we do know that we have end of Q2. We also had some large U.S. numbers, macro numbers come out last week, right? It was an incredibly active week for Ethereum and Bitcoin, and then broadly U.S. equities as well. We had the CPI, we had the FOMC, and then we had the PPI, right? CPI came in good. The FOMC came in unchanged, right? Everybody was looking at the dot plot. Dot plot didn't change. So we got a large rally based on good inflation numbers. Bank of Canada started dropping their rates. ECB started dropping their rates. That we started a rally in risk on assets, right? That we saw over in here. And then, boom, we let it all go on the back of the FOMC. The PPI came out on Thursday, and that came in a bit under as well. And it was a non-event, right? And so as we went into Friday, we got some large selling to end the day. That was quickly reverted into the weekend. We traded higher into the weekend, and then yesterday we let it all go, right? And so as we know, the biggest thing on the horizon looking forward is the ETF, right? So out of the US, it has been cleared, right? 8 ETFs got clearance. When do they start actively trading? There's been news that it's going to come out in September. There's been rumors that it could come out as early as the next few weeks, right? And so that's what we're seeing in the market is July 5 expiries in Ethereum are the ones to watch right now. The reason for that is that's the week after your Q2 expiration. But it's also where you're getting a lot of that speculation around maybe it happens, maybe it doesn't. We don't actually know, right? And so let's run through some trade theses. We are in summer trading. That's the last kind of piece that I want to hit on here is summer trading could be lackluster. And how does that impact um, kind of the markets, right? And so when we think about markets, a lot of times we think about markets as this, right? The market goes up, the market does nothing for a large period of time, the market goes down, the market does nothing for a large period of time, the market goes up, etc. Um, as you walk into the derivative space and predominantly the option space, there is this underlying mechanic called volatility, right? And so while this move was a large expansion in volatility back in May, this move was a large compression, right? And so independent days here of large sell-offs that are a little bit out of the normal range. We saw bumps and realized vol, but largely what we're seeing in the vol markets is a drift lower, right? And so what does that set up for? Basically, I'm walking through the whole thesis process, right? So what does that set up for? So if we know that September could be lackluster, we may or may not get an ETF announcement. An ETF announcement might spark a firework to the spot markets, but largely then back to the vol markets. Um, One, you could speculate on that. Two, you could also say, no, vol's a little bit overpriced here, and we'd like to be sellers of vol and do some of those trade tactics. So I think today, what I think would be cool to talk about is going through both, right? So buying vol and selling vol. What are some trade strategies that we can do so that when you guys are trading, you have two strategies under your belt and you're looking at them from both sides of the trade, right? So. Um, let's go out here and let me drag over here and we'll drop. Yeah, we'll keep this up over here. Kind of drop this a little bit. So there's a couple things. One is, let me see if I can make this smaller and make everything fit on the screen. Let's go through a scenario that we saw actually transpire last week in the options market. So there was a large seller in at-the-money calls in Ethereum. They were targeting 3,800. I think it was June 21s, right after the FOMC, right after the CPI, targeting short duration options and basically taking a stance on the market's going to lose volatility, right? The implied vol in the market is overpriced relative to what we're going to see in the next 14 days. What does that mean? Implied volatility is um, is a large component of the options market, right? And so you can see here, this middle price here is your implied volatility numbers. You'll see that June 19 has its individual at the money implied vol. You go all the way out to July 5s, you have a different 62.2. And then you go out to September, you're going to see a slight higher implied vol. That basically is going to tell you what the market is pricing the expected move of Ethereum in this duration, in this time period, right? So how do we see that? How do we take advantage of it? And what did this trader do um, that that we watched trade out, right? So again, Stephen, I know you're in the room, so this is Greeks Live. And if you have any questions, feel free to hop over to the Discord channel and I'll drop it in there for you guys. But underneath the Data Lab center, or sorry, not the Data Lab, we can go over to P&L analysis, actually position visualizer, and use this as a pretty good tool on pricing out some theses, right? And we spent last probably 10 minutes talking about tons of different theses and playing around with this idea, right? So let's pull this up. So based on this move, if we want to be actually, what did this trader do? We'll start there and then we'll go through a whole thesis on how to buy vol too. So this trader came in last week and sold a ton of, I think it was 10,000 ETH at the money and basically delta hedged it, right? And so what does that mean? The thesis that the trader was making was volatility was overpriced, and we weren't going to trade any lower. We weren't going to trade outside the bounds of what the options market was already pricing in, right? So I'm going to put through a similar trade. It's not going to be the exact same one just because I like to replicate the duration of the trade because it'll make a little bit more sense. So currently we're trading at 34.28. If we come out here to the options market, I'll pull up another tab just so we can toggle back and forth. The options market, we're looking at about a 62% fall. But more specifically, if we target these 3400s, the straddle price, and what do I mean by the straddle price? I mean a buyer of both the 3400 calls, a buyer of both, and the puts gives you that that price of what the market's expecting the move to be, right, in this duration period. So I got a calculator over here. I'll drag over and we'll price that out real quick. So the 3400s, if we were to be buyers of the calls, it's going to cost us roughly 156.2, right? And if we're going to be buyers of the puts, it's going to cost us around 121.5, so plus 0.8. So you're looking at around 278. And I'm pricing out the straddle. So a straddle is you buy both at the money call and put, and that'll tell you what the market's expecting the move to be. So 278 divided by our trading price, right? So the market's pricing in potentially an 8.1% move in the next 9 days, right? 9.5 days, right? So 9 days, 14 hours left on these contracts. If we're to divide it by that, let's just divide it by 9.5 roughly. Market's pricing in about 85 bips, so 0.58% a day in volatility, right? So what this trader did was they sold that, right? And so what does that mean? Let's put it on. So if we came in here and we were selling at the monies, right? So 3400s. Let's come in here and we'll sell some 3400s. Let's sell 100 of these, right? In the June 28 expiration, just to be clear. And what they did was, you'll notice, and based on kind of previous webinars that we've hopped on and talked about, there's all these different Greek exposures to the market, right? And so you'll see that this risk payout has us losing over 35.50, right? And I'll price this out in US dollars just to make it a little bit easier. We'll do everything in US dollars. But what the trader did was they hedged off their delta component, right? So they wanted to just remain short vol, right? We have a little bit other exposures to this. I'll explain in a second. So, so what they did was they came in and they bought futures against. And so if we were to delta hedge this out, we're short 55 deltas. We'll come in and we'll buy the exact amount of that in ETH, right? What is that? 54,132, right? So we'll come out and buy that, and you'll notice that this is the risk payout that the trader took, right? And so what does that mean? We can mess around with this, and we went through the whole pricing process, right? So the market's expecting around 85 bips a day and realized fall. And if it doesn't, we know the options market's a little bit expensive. So what this trader did was they took a short vol stance, and we can play around with the vol. So let's drop the vol by 10. And we'll see that this green line is our unrealized P&L. So in this scenario, if all of a sudden just the vol market were to drop by 10 points, right? If we were looking at a 62 at the money, right? And it dropped to a 52, we know that our P&L would look like this. We'd have the opportunity to cover it up for around 2,300 bucks. Or if time were to pass and vol didn't do anything, right? So let's say these are 9-day options. Let's say 4 days passes, right? Around half of that. We would be looking at a realized P&L of 3,500 bucks, right? So basically what the trader did was they offered out what's considered to be gamma to the market. The reason I say it like that is because we'll look at our total portfolio and we'll notice that we have our deltas basically hedged off. We're still exposed to short gamma, right? And short gamma can be seen over here as a large move outside of the expected move out of the options market, or a large move out of here. And through that process, they basically took a stance that said, no, fall's overpriced, gamma's overpriced, we're going to sell it. And during that, I don't actually have the real prices, but just looking at the market over the last week and a half, we didn't move a lot, right? And vol has decreased quite significantly. And I'll pull up the data lab portion of this. And these are your at the money vols. What we can see here is they did decrease through that period of time. We did get some buying after last Friday, but that was the stance that was taken. So this is one way, this is one trading strategy to basically take an advantage of a market where you think, hey, maybe we're going to trade sideways for the next 3 months. Let me clear all this up. Yeah, we're gonna trade sideways for the next 3 months because it's summertime trading and we're not going to do anything. We have U.S. primaries in November this year. We also have potentially ETF if it doesn't get listed earlier, potentially in September, setting up for rate cuts, U.S. rate cuts potentially at the end of the year. All these kind of things that could lead positive catalysts to the market. But you think, well, everybody's going to take a vacation this summer. I want to sell some vol. That's a good way to do it, right? You can also do it inversely, right? You can sell some of the puts and do the same kind of trade, right? So if we came out to June 28th, we sold the puts, 3,400, and we sold 100 of those, right? We got a different payout, risk payout. You'll see that we're actually long some deltas. So we'll come out and we'll sell those, right? So because we're long, we'll sell them. If we're short, we'll buy them. And that's how we can take a vol stance on the market. So let's look at those. The 51.34, we're long, so we need to sell some. Same risk payout, a little different pricing. And the reason for that is because of this skew in June 28 expiration. We'll talk about that a little bit more in the future, but this is a good way to sell some options and then delta hedge them against and take a short stance on vol, right? So that's start to finish on a thesis. How you'd execute is you'd come into this Bookmap, and you can do the exact same thing. Just because I have BTC up here, we can pull over ETH right here, right? You can do the exact same thing. The optimal time in which you'd want to execute this trade is when you're expecting the market to stay contained, right? So you have buyers stepping in on the bottom side, you have sellers on the top, and just a lack of nothing, right? And that leads to a profit in the form of shortfall, right? So the inverse of this trade, which is a fun one, is how do we get long vol, right? And so instead of doing the exact opposite of this, actually let's do the exact opposite of this. We'll just make it easy. And then another strategy that I do want to talk about in the future is butterflies. Butterflies are fun to use to get long vol. They also work pretty well when overlaying them with some risk that you potentially have in your portfolio. But we'll dive into that maybe next week. So the inverse of this, right, is okay, we're looking at a market that basically is pivotal, right? Either we're gonna base here off the previous month's mid, and this is the previous month's midpoint, and we're gonna trade back higher. If we get back over this 34.65 area, what's the expectation? Well, the expectation is we're gonna trade potentially back to 3,800, right? In that scenario, we'll look at vol and see if it's underpriced, right? So how would we know? So if the expectation well, let's go through a theses, right? The market starts to base here. We're looking at, hey, maybe it starts to base here. We have potentially an ETF announcement in July, right? And maybe the guys on Twitter are right, and July 2nd's the day. Maybe it comes later in July. Maybe it doesn't even come and comes in September. But if the thesis is potentially fall could expand, and how do we pick the strike, right? Well, if the thought is July 5 is that risk area of the potential announcement, let's look at some of those, right? So currently we're trading at 34.15, 34.16. We'll come out here to July 5 expiries, and we'll see what the straddle's priced in. Well, actually, we'll see what some vol's priced in, right? So we want to get long some vol. Let's get long the calls, and we'll sell off the exposure that way. So in order to get long vol, you got to be a buyer of options, right? And the reason for that, without getting too technical, is they have convexity outside of just your perpetual markets, your spot markets that basically just have linear exposure, right? So let's come out here and we'll buy at money calls, right? And so 3,400s, those are going to be, we're going to buy the July 5s. And the reason that we're picking that target is going to be solely based around potential expectations that an ETF gets announced or doesn't, right? But if it does, let's see what that payout could be, right? So we'll come in here. Instead of being sellers of options, right? Sellers of options, we're going to be buyers of these options. So 3,400 calls. We'll see here that this is our exposure without a hedge, but we're looking to get long some vol, right? So let's hedge off this deltas. So again, we're long 55 deltas. You'll see this Vega component, which the Vega component here is what we're looking for. That's your volatility component. So we'll come out here and we'll sell some futures against, right? So sell 55.216. And we get this exposure, which is the exact opposite of what we were selling, right? And so what does this mean? Our break even here, it really depends on when it happens, right? Because we are short, or we are paying some theta here, right? And so if time goes by, right, if we price out 3 days, there's always a cost of carrying vol. And the reason for that is basically has infinite upside potentially, right? If you're buying calls, nobody said tomorrow the price of Ethereum could not be $50,000, right? It's unlikely, but it's not impossible, right? And so there should be a cost for that. And the reason there should be a cost is because there is significant risk in hedging that exposure, right? So 2 days from now, 2 days from now, yeah, we'll just go 2.5 days, 2.6 days. We need to move outside of 3,600, right, to make a return on these. And this is the green line is our unrealized P&L. So if we think that the move up to 3,800 is possible in 2 days, absolutely, vol is underpriced here, right? Because what would our P&L be at that area? Our P&L would be roughly $3,700, right? But because we have to pay for vol, let's say that 6 days nothing happens. Well, now if we look at our P&L out to 3,800, we're looking at 886, right? So still in 6 days, the vol market's underpriced if the expectation is we're going to trade to 3,800. But you'll see that there is a significant decline and risk when holding vol for a long period of time, right? That's why a lot of people love to sell options. However, hitting some home runs in options does give you that 10-to-1 payout from time to time, right? So let's say home run, hit it out of the park with this strategy. ETF gets announced in the next 2 minutes, right? Where could we go? We could go to 3,800. If we really hit it out of the park, where can we go from there, right? We'll test the UP, which is going to be your 4,000. And then the expectation is if we break the UP, we could go to that 44. Why it matters to get long vol and why sometimes paying for vol inside of short vol portfolios, right? Long vol is interesting a lot of the times as a hedge versus a speculation is because it does have a significant payout. It can have a significant payout. And so in that move to a 4,400, again, unlikely that it happens in the next 2 minutes, but your payout would be 22,600, right? And so that's the exact opposite approach to that strategy that that trader put on last week. Why would the trader put that on last week? The reason for that is because of so the options market's forward looking, right? And so because we have expirations in all of these different expiries, these all have to be priced, right? And how do they have to be priced? Well, they have to be priced on a risk basis, right? So if you're a buyer of these, there's a market maker that needs to sell it to you. And so that market maker needs to know the risk that they're taking on, right? And so if you were to come to me and say, hey, I want to come out and I want to buy some of these DECE options, well, I know for a fact that that has the possibility of covering, I know for a fact it has it's going to cover the US primaries, right? Because those are going to be in November. I know for a fact that that could potentially cover a US rate cut, further rate cuts out of the ECB, further rate cuts globally, right? So that has a large impact on how I think about risk. It has the potential of covering an ETF listing. More likely than not, it does, right? The speculation is July. More the confirmation was September, right? That all needs to be priced in, and I, as the market maker, will price that in the form of vol, because either you're taking a bet that vol's underpriced, and I'm taking a bet that it's overpriced, and I need to hedge it, right? And so, saying all of that, that's where you do get a lot of these vol pricings, right? And so last week's trader took the bet that because of all the U.S. headlines, they wanted to step in and sell some of that vol that was being already priced into the market. And so they would have benefited, right, from lack of realized movement in the ETH market and relatively quiet for the most part, right? So these are two strategies, both inverse of each other, right? One's long vol, one's short vol, about how to trade around both kind of a larger thesis, right? So looking at price map, quantitative, qualitative data. Here's a pretty pivotal point. If we rotate down, where are we going to go? We have the potential to really extend lower. If we base here and we probe higher, where are we going to go? We have the potential to push back to that previous month's close in that 3,800 level, right? If we look at Bookmap here, right? This is Ethereum. Where are we going to execute, right? Well, we know for the most part, some of the larger liquidity bands are going to be in this 3,350 area. You're getting a little bit of support here. You have sellers up in here, 3,480, right? But so using kind of a large outlook and really dialing in to the micro outlook, right? And then the strategy is in the form of what you think, right? So if nobody's really stepping up to the plate and vol is going to be short over, I mean, vol is going to be overpriced over the next couple months, right? Everybody's away at the desk. Super hot in Chicago. Maybe they're out on the boat, not clicking buttons. Then maybe you saw some vol, right? But if the thesis is the market's going to explode higher or potentially roll over in a very fast, aggressive manner, well, maybe you're a buyer of vol, right? And so those are two ways to approach the options market, utilizing a fact-based method, right? So to kind of wrap it all up, I know, markets are fairly quiet today after a large move yesterday. Um, what we're trying to do here is it's fact focused, right? And so we are at a pivotal level here at the 3,400. If we start to base here, where are we going to go? We have the potential to really push those upper limits at that 3,800 level. If we fail here, where are we going to go? Well, we have the potential to even rotate much lower, right? And test some of those previous month lows. If not, test the R level, which is going to be your 2775, right? Which is in alignment with your previous month low. Then the next piece here is, yep, our method incorporates statistical outside view, which helps to slow down decision making, right? So looking at the market right now as it's in a pivotal area, and playing out all scenarios. At the end of the day, you don't always know, but you got to let the data speak for itself, right? So these are facts over years and years of data that have been validated, and these levels are exactly what's being supported, right? 3,615 being a very pivotal level last week that we failed at early this week. And then playing out all scenarios, right? And playing out all scenarios in the form of risk and reward. Because at the end of the day, what are we trying to do? We're risk managers first. We're assessing our risk, and then we're thinking of creative ways to express a view on the market, right? And so this week we talked about some short vol, some long vol strategies, and the reason for that is to kick off summer trading. Vol is likely going to be in the forefront in either a negative light, meaning we don't do anything and people really get bored with the crypto market. Well, I mean, we as traders can take advantage of that. We went over a scenario and how we could do that, and what we saw hit the tape last week. A trader took that stance, or maybe we get some fireworks right around the U.S. holiday. And the rumors are true, and ETF gets announced, and the vol market is very much back alive, right? So thinking about all different scenarios and how that impacts current positions and then potential positions that we want to put on in the future, right? So at the end of the day, we want to trade with clarity. So feel free to reach out to us. We're always around. So either in the Discord channel, feel free to ping us over there. You can reach out to us at dharmacapital.trade. We are on Twitter, so dharmacap trading, YouTube at Dharma Capital Trading, Substack, Dharma Capital Trading, and then feel free to email us as well at info@dharmacapital.trade. Yeah, last piece here is, feel free to reach out to myself as well. My name's Spencer Regal. I am the chief option strategist over at Dharma Capital Trading. So even if you want to just talk about some options, some things that you have questions about, feel free to reach out. Maybe some things that you're seeing in the Bookmap, and you want to execute in real time. We can talk about scenarios and risk, and potential rewards based on those ideas as well. So thanks for hopping by today on a Tuesday, and we'll see you next week.